Hey Johnny, can you hear me? Testing. Hey Johnny. For some reason we cannot hear you. I think it could be your audio or mic.
There we go. AirPods. How did my configuration change? All
There
right.
you go.
We're going to run this one over. I apologize for the audio, not having the AirPods connected. But as you see, we're talking about the K-shaped economy today and really diving in that across the board that, we kicked off the Deal Makers Club this year really to elevate the conversation and bring it on the guests to really dive into things that are applicable to the economy and investing, and then at the same time and really an emphasis on, I would say, real estate investing as well too, and where the opportunities are, where the opportunities maybe aren't, where we're seeing some of the pain, what I'm seeing from the conversations that I'm having with billion-dollar firms that are placing capital in different asset classes within real estate. What does that look like? Really, the ultimate goal is to give you a glimpse behind the scenes and help you make more informed decisions as you're looking to show up. And I think one of the articles that I came back to this week really pointed back to an article I wrote about the K-shaped economy the end of December. That if we're not a follower on LinkedIn, definitely would love for you to kind of tap in and check out some of the newsletters that I've been putting out on a weekly basis. But essentially, the K-shaped economy, it just breaks down that is the economy right now is neither good or bad. That you just got it's fractured. You have winners that on the upward trajectory that own stocks, own assets. They're in real estate that's being impacted by inflation, and you have those that are going down that don't own assets, that aren't high wage earners, that are consumers and really focus on consuming and not producing anything, or not owning assets and not owning businesses that are going to ultimately hedge them against inflation. And I think one of the things that we're seeing right now, that the dollar has fallen almost 10% over the last couple of years. The value is going down. We see it with what we're having to pay for food, for fuel, for everything, that everyday living that is being fractured right now in the economy. And so the thing is, you have to understand, how do I become an asset owner? How do I buy more assets? I was in a conversation or conference last Friday for the Mid Atlantic CCIM, uh, their kickoff conference for the year, in Ashburn, Virginia, and the emphasis was on data centers. For those that don't know, about 90%, depending on who you talk to, they say from 50 to 90%, we'll say 90% of the world's internet traffic comes through Loudoun County, Virginia. It's the epicenter of data centers. And, there's a lot of nuances and challenges, but one of the things that the build out for artificial intelligence, when you look at NVIDIA, OpenAI, Facebook, Google, Oracle, and a lot of the investments that are happening across the board in support of the data centers, there's still a lot of unknowns, and it's a lot of capital that's being brought in without a lot of rigor in regards to the scaling, the build out of the IT infrastructure, the modeling or understanding how much capacity is actually needed for certain use cases. That a lot of that is still, it's the wild west, that a lot of companies are just building. They are overbuilding, to the tune of 30-40% overbuilt for the use case, because they don't know what's coming in the future, and they don't know what they're going to actually need 4 years from now from actually going through with building out. Because right now, across the board in a lot of areas, that power is the number one long lead item for any development. They can build up the infrastructure, the external building, the security, and the IT infrastructure on the inside, where right now over 80% of the cost goes into. But the power is the long pole in the tent. We're getting power to these actual sites. And the cooling is another consideration that they're looking at as well. But I tell you that right now, AI on so many levels, we don't know the impact that it's going to have. Right now, they're projected over $1 trillion of investment between now and 2030 in data centers, in directly in support of artificial intelligence. And so if you're on the right side of that, you could be doing great. But potentially, those on the bottom side of the K-shaped economy, you could lose your job, you could lose income, you could be definitely negatively impacted by, the right now the proliferation of AI, where we're seeing all these job losses. So I think right now we're in a unique time. No one really understands what exactly is going to be happening. But the thing is, I can tell you, no one cares about you and your family's well-being and your portfolio more than you do. And so I think that's one of the things when we start looking at real estate and how do we position ourselves. So I think, diving into real estate and, the wealth position, that a lot of it right now that we're seeing the, all-time, multi-decade low in transactions. Last year, were under 4 million transactions that happened in single family real estate, that we're seeing the big impact from the lock-in effect, where you have historical amount of homeowners who have less than 3% interest rates, even less than 4% interest rates, that are keeping a lot of inventory on the sidelines. And so right now, when you start talking about the impact to GDP and transactions, that you have a lot of jobs that are tied to real estate, whether it's construction, renovation, Home Depot, Lowe's, some of the big providers. But also outside of it, you have title companies, you have the tax revenue, you have attorneys, you have real estate agents, you have buyers, you have sellers, and a lot of money that's moving through the economy for every single transaction. You have appraisers, you have home inspections. And so all those different things that are happening with homes, and when you don't have a lot of transactions happening, that means that, guess what? There's not a lot of money that's changing hands with these transactions on a daily basis. And so one of the things that we're seeing right now is the lock-in effect. Home ownership is right now at a all-time low. Right now, for those that aren't really tracking it that close, the average home buyer, there's data out there that right now the first time home buyer average age is 40 years old. Think about that. If you come out of college 23, 24 years old, right now the average is 40 years old. So you're going to work 15, 16 years before you can afford to buy your first home, which is just ludicrous. It's crazy just to conceptualize it and just think about it. But that's where we are right now in the economy, just because affordability is at an all-time low. That for most people right now, it's cheaper to rent. But guess what? Who does that benefit? It benefits landlords, those who own the actual assets. And so that's what we're seeing right now with the lock-in effect, with low interest rates, but then also appreciation that's happened over the last 5 years. Asset values have gone up with appreciation anywhere from 30 to 40% the last 5 years. If you own real estate, it's been a great time to be an owner. And so I think one of the things that you have to look at is with real estate is, how do you get involved? Can you find dilapidated buildings to force appreciation to become an owner? Should you house hack and maybe rent out your basement or rent out, partial of the rooms? If you're a single individual, you don't have a family, maybe that's something that you consider. Or maybe you buy a 3 unit or 4 unit where now you're living in a unit with your family, but then you can also rent out two, three, the second, the third, or fourth unit. So that's one of the things that a lot of investors that I'm seeing right now, they're being more judicious. They're thinking outside the box on how to build wealth, how to buy assets. We see with the current administration, they're looking at different things with the 50-year mortgage, which I think my perspective is a horrible idea for the consumer. But then also you're having things where they're lowering the credit scores. They're stopping institutional buyers from buying single family homes, which when we look at the data, institutional buyers own less than 5%, somewhere between 3 and 4% of all single family homes are owned by institutional buyers. So there's not a lot of demand that's going to be created by limiting them from being able to buy single family homes. So I think the thing is when we start looking at the economy, that there's a lot of different ways that you could position yourself, but understanding how wealth is working, how money is moving through the economy, that you have to understand how does this align to you. And one of the things that I'm seeing on the advisor side is a lot of billion-dollar funds are looking to buy Class A multifamily. Over the last few years, with the run up in interest rates, has caused a lot of pain on the commercial side and reevaluation or reset of values for commercial buildings. And so that's one of the things that we're seeing right now with a lot of sponsors that are looking to buy Class A multifamily built within the last 2 or 3 years, that are now looking to place capital into those deals and buy below replacement costs and buying anywhere from 20 to 30% below 2022 values when the market was like at recent all-time highs for the last cycle. And so that's one of the things that we're seeing right now, that a lot of capital is going back as things are bottoming out in regards to valuations, and we get ready to run up into this next cycle, that you're starting to see money come off the sidelines from the last couple of years and start getting into multifamily in the areas where we're still seeing job demand, where we're still seeing growth. And then we just published a newsletter this week that talked about the U-Haul data on Texas, Florida. Where are we seeing the most inbound flow of population growth? Where are we seeing the jobs at? And so the U-Haul indicators, one that's been around for years, that really drives where demand is going and where people are moving to following the jobs. And what does that mean for you as a real estate investor? Because you want to own real estate, you want to own assets where there's going to be jobs, population growth, lower unemployment, but then also that bodes well for you as on the investment side. And so the thing is, you can follow where the institutional money is going. But if you don't have the income, you're not able to invest, or if you're looking at the things that aren't necessarily moving the needle, then it could be at a detriment to you. And so I think that's one of the things when we look at the economy right now, it's not the same for everyone. So depending on where you are in your business, you may need to be more forward facing to consumers that are looking to spend money, because a lot of people in the economy are looking, they're barely keeping their head above water, and they're focused on trying to stay stagnant, to tread water, to stay in the same position. And so it's a struggle. And so I think that's one of the things that we have to realize, just where we are right now in the cycle, and understanding where the market is positioned itself. Because where we are a year from now, we have the Federal Reserve chairman being changed out, with Jerome Powell leaving here in the spring. Who knows who's going to be replaced? We see some inkling of interest rates drop below 6%, but now they're back over 6%, where we have pent up demand. We saw a lot of refinance activity that popped off, once rates drop below 6%. So there's a lot of things, a lot of headwinds that we're still focused on. We had the Greenland discussion. Are we invading Greenland? I just read an article about the uprising in Iran. They killed, right now, the numbers are predicting over 30,000 protesters that were murdered, executed in 2 days in Iran earlier this month. So just a lot that's going on across the global stage. Of course, we have Venezuela, and what does that mean? We're seeing that a lot of the oil companies are pushing back, saying they're not interested in going back and building out the oil infrastructure that could take a decade to actually build out, and just the hundreds of billions of dollars of investment that would need to happen to make that a reality. And so I think across the board, there's just a lot of different variables at play when we start looking at the economy, and no one knows. I think some saying that it's an AI bubble. with the data centers, over investment in some of those areas. I know one article I read about Oracle and OpenAI. I think they were proposing a $500 million excuse me, with the billion dollar request for funding to build out additional data centers. And right now, some of the private equity is pushing back and saying, "Whoa, let's hold on before we commit to this. What is the plan?" Because right now, there's been limited to no return on all this capital in the data centers, and the open AI, and the when you start looking at Gemini and a lot of these AI models that are out there, they're not returning investment. All the billions of dollars of investment haven't materialized into actual revenue where investors are getting paid back capital. Everyone's just speculating. So I think there's a lot of things to see what happens and how it materializes. So I think it's a time to be vigilant, a time for really be focused on diversification, where you're not over centralized in one asset class, and you're looking at the strategies and following the data. Where a lot of the institutional money is going, where are the things going, what are we looking at? Gold is record highs, silver record highs, and so when you look at your asset allocation, you need to really understand, hey, where's the smart money going? How am I operating this economy? What ways can I increase income? Should I pick up a second job? Should I look for, maybe leaving my company, which could be risky right now, just because there's, less hirings. A lot of jobs are laying back, and they're not firing people, but they're not hiring people. So maybe should you go take a position where you can go and have a increase in revenue and promotion, but could you end up at this new job 6 months later and lose your position? I don't know. So those are some of the things that, a lot of people that I'm having conversations with, they're looking at, hey, should I just stay put, ride this out? I don't really want to, rock the boat too much and really look to go to another job, another location, and risk, being on the outside looking in, first one in, the last one in the door, first one out type situation. And so I think those are some of the things that you have to be cognizant of right now, and understanding what's going on and how you're positioning your portfolio. I'm still bullish on real estate. There are going to be some great opportunities, right now in the market, where a lot of commercial loans are resetting, that were bought in 2020, 2021 at all-time highs, and then interest rates have gone up. And so a lot of valuations are coming in lower. And with commercial mortgages, that sometimes you have bridge debt that is more short term, but then also loans anywhere from 5 years, 7 years, and that can cause you to have to refinance or sell, just because you're going to have to bring a lot more capital to the refinance table to close on those deals, just because rates have gone up. Where you underwrote, being able to exit at a 4% interest rates, and right now rates are anywhere from 6% to 7%, just depending on the source of capital. And so I just think right now, when we start looking at the K-shaped economy, you got winners and you have losers. But I think for all of us, we need to look at how are we allocating our capital, how are we investing, because the owners and those that own assets are going to be the winners at the end of the day. So whether it's the stock market, where it's buying real estate, where you're taking advantage of like the 100% bonus depreciation with the legislation changes out there for commercial real estate, and you're really having a plan, and you don't have a plan, you need to talk to an advisor, talk to someone that can help you build out a plan. For me, I love working with real estate investors, especially those looking to retire, to become more passive and are interested in more institutional real estate deals. Would love to have a conversation. And really, one of the nuances that we really focus on is 1031 exchanges. So working with brokers, working with owners, and qualified intermediaries that are looking to help clients that are looking to sell, but looking to move capital into institutional real estate versus picking up another active management, I would say, challenge or headache, just because they have to defer taxes and look at, getting away from the tenants, the toilets, and the trash, and being a lot more passive with how they set up their estate and their portfolio long term. With that, it's a lot to be seen. We're going to see how things play out in 2026, but the thing is, you can't take your eye off of everything that's going on. You can't be asleep at the wheel with the decisions that you're making. And make sure you have the right people around you, the right conversations, you're in the right rooms, because there are a lot of things that's happening, and there's a lot of unknowns. And the thing is, you don't want to be making decisions in a silo by yourself. That's the last place you need to be right now. That you need to be in the rooms that are having conversations on, where they're allocating billions of dollars. Where's the data? Where are the things that they're making decisions for portfolios, for pension funds, and things like that, that you need to have be in alignment with those same type of things. And it may not be where it was 5 years ago. It may not be fix and flips. It may not be serving the single family first time home buyer. It may not be on the high end luxury uh, asset class, but maybe it's, it's picking up more rental properties, building out your portfolio with that cash flows at today's interest rates, and being able to buy assets at a little bit lower. Or it may be looking at protecting your wealth and getting into institutional deals with professional management, and not necessarily chasing potential higher returns in more crime infested areas, areas where there's a lot more, less income, a lot more turnover, and now you're putting your capital at risk just because you're chasing assets, just because it may look good on paper for a number perspective, but when you get down to the actual operations and the execution, you're actually by taking a bite of a lot more risk than you need to for where you are right now in your portfolio. So if you're looking to have some of those conversations about your portfolio and how you can maybe reallocate capital or reallocate equity within your portfolio, and maybe considering the 1031 exchange, would love to have a conversation. That's what I'm here for, to help you get clarity around what's your next move in real estate and building it out. With that, we have a coming up in February. I'm excited about some of the conversations we have a fund manager. My guy Ray Reyes is coming on, and he's going to be talking, breaking down, some of the due diligence that as a fund operator that they do on multifamily developers and sponsors on doing deals. So that's going to be a really fun conversation. We're going to have another conversation about intellectual property and music rights and buying the rights to music with a recent fund that launched, that are looking to bring to the marketplace, just exposing more investors to opportunities to buy intellectual property. And we see a lot of it for most recently Justin Bieber, T-Pain, with selling their rights to their catalog, and just what that looks like, and just the different ways where companies and how they monetize that, and the different ways with streaming, but with production and producing beats and things like that, on how the actual money behind how that is monetized, because they're just not giving money away and buying someone's catalog for no reason. There's underwriting and analysis and performer that goes to that. So we're gonna have that conversation as well too. Next month, the annual commercial real estate conference is kicking out in Birmingham. I think that's on the 26th of February. So that's going to be great as well too. Looking forward to getting back down on the ground there in Alabama, and doing some networking, and having great conversations with other real estate investors, because I'm really excited to see where they're going. Usually they'll have someone from the Atlanta Federal Reserve Bank. They'll be there sharing. A lot of times you'll have the CEO for the Alabama State Pension Fund. So all the teachers, all the state employees across the state of Alabama, the guy that runs their pension fund. So all the money that they allocate to their 401k, he's the guy that's managing all those investments. So it's really interesting to see what they're investing in and what their goals are, and their allocation to alternative investments, to real estate, to just a broader market. And so when you're in these rooms, that's how you get insight, and you get the information on what you should be doing for your portfolio. And so I'm excited about those upcoming opportunities as well. So yeah, if you're looking to exploring 1031 options and you want to understand, hey, is it the time to sell? What should I be doing? Would love to kind of have those conversations and go forward from there. And with that, make sure you follow me on LinkedIn. Dive into the articles that I'm putting out there on a weekly basis to help you guys make more informed decisions. And I'll see you on next week's Deal Makers Club. Let's go. Let's make some equity happen.